Good morning.
Good morning. We are very pleased to welcome you on Crido Taxand webinar. Myself, Paweł Toński, and my colleague
Magdalena Podolska.
Will present you the revolutionary changes in the Polish FinCap, which we believe impacts all intra-group financing. We will, of course, try to explain also why we allowed ourselves to call it revolutionary changes. Revolutionary changes within the webinar. Since this is webinar, you are also we have also possibility to answer your questions. You can type your questions on your computer. We will see them, and hopefully we will be able to answer them. If anything will be, let's say, too difficult or too much going into details, then we will just allow ourselves to answer to this question later, directly to the person asking. Okay, so quickly the agenda for today. We will start with presenting the old rules, because we believe it's good to have a point of reference when discussing the new rules, especially that taking into account that the changes are quite broad. We'll go through new rules, introducing let's say the basic, the standard option, also the alternative option. We mentioned we'll show an example comparing all the options, the old ones and new ones. And then finally, some, let's say, better news, which are grandfathering rules, which refer to the currently existing loans, and also some ideas about the new structures. So let us start with the old rules versus new rules. Magda?
In fact, everything what we are talking about now are the regulations which are already published and already approved by the Parliament and by the President. So no surprises are expected in this regard, and we already know what is the wording of the new law. It was adopted in August, so still we have some time for preparation for the new structures for the financing. And in fact, the ThinCap rules were covered by the much broader amendments to the CIT law, which covered as well distributions in kind, CFC rules. So this is not the only one important change to the Polish CIT regulations, but one of the major.
Okay, and the CFC, perhaps for the foreign people being on the webinar, this in fact impacts only Polish taxpayers having companies abroad. It does not impact the foreign companies having the Polish companies. So that's why we believe it's not of major importance for the, let's say, foreign listeners.
And the new regulations will come into force as of January next year, 2015.
Okay.
As a point of reference, we are talking about the old rules, just for your reminder. The old rules assumed that all the loans given by a parent or a sister company were covered by ThinCap, but not all parents and not all sisters. We were thinking much more about the majority related parties, so the assumption was that a parent or sister company needed to have at least 25% of shares in a company.
Yeah, and what's more important, it still has to be a direct parent or a direct sister.
Which is very important in comparison to the new rules. The shareholding was measured by the voting rights rather than any profit participation or just interest in a company. And for the purposes of the currently existing ThinCap regulations, we compare the indebtedness of the company to the share capital of the company in the proportion 1 to 3.
So, in other words, if the debt exceeds 3 times share capital, we enter into trouble, so to say.
And we make this comparison of the indebtedness towards the share capital at the day of payment of the interest or compoundment of the interest. So this is a kind of a reminder for the old rules. The new rules assume that we look at indirect parent or sister company. So in fact, this means that almost all entities related to some extent by at least 25% with the borrower will be covered by TINCAP, which is a kind of a revolution in the Polish regulations.
And what's quite interesting, it was relatively easy to extend or broaden the scope of the TINCAP, because in the existing regulations only one word, indirect, was added into sentences, which immediately extended the scope of the TINCAP rules. Well, we will continue with the new rules, and then there is one question, so we'll come back to the question after discussing the new rules.
What is not changed, we are again looking at the voting rights in the borrower, not the profit participation, not the interest, but the voting rights. And we measure the indebtedness in a quite different approach. We look at the debt of the company, but excluding the related party financing. And we compare it not to the share capital of the company only, but to the whole equity, which is determined at the end of the month preceding the month of repayment of interest.
Yes, and there is one question which refers to grandmother rules. I think it refers to the old rules. In the old rules, the grandfather loans, so not the direct partner, but the company above, grandmother rules, grandmother company, sorry. So not the direct shareholder, but the company above. It was not the loans from that company were included in the overall debt, which was calculated to determine this 3-to-1 ratio, but the interest on such loans were not subject to TINCAP restrictions.
We will show it on the next slide. In a moment.
Yeah. You're right. And in new rules, everything counts, let's say.
Yeah. Also the grandmother loan. On the next slide, you can see the summary of the main changes to the TINCAP regulations. So, summarizing them, we are looking at indirect shareholders, which is the revolutionary change. We are comparing the indebtedness of the company with the whole equity of the company, which is not so easily manageable and not so easily under control of the company as it was in the case of the share capital. So this is also a kind of a revolution. Yeah,
I mean, share capital, you can fix it and you in fact control it, whereas net equity changes, for example, depending on the result of the company. Okay, so how the old rules worked in practice. So we start with a very simple example. We have a parent company which is subject, the loan from such company is subject to TINCAP, that's why it's all red. If we go further into the structure, we can see the picture is becoming a bit blue, which in this case is the good news. Namely, loans from grandparent and subsidiaries were not subject to TINCAP, so the interest could be fully deductible.
Again, we are looking at the majority stake in the company, so everything below 25% was excluded from TINCAP, and the parent here in our example has 80% of shares, or in fact voting rights in the borrower.
And it could have anything above 25 to qualify into the rules. And then even going, let's say, expanding more, if we look at the sister companies, then a direct sister, if we have the same parent, the direct sister is generally qualifying unless it has, the parent has less than 25%. So that's why we have also blue parent, let's say. And if we look at that, and then we see that on the, let's say, the red sister company is qualifying. The loan from this company is qualifying as a loan subject to TINCAP, whereas the loan from the blue sister company does not qualify because it is the shareholding is below 25%. The shareholding of the parent in the borrower. So
summing up, we have lots of the good lenders in our examples, and as they are all blue. And if we go for further slides and look at the examples for the...
Maybe one more comment, because clearly we have not depicted here all possible companies, but in fact, any company which is not a direct parent or direct sister would also be blue on this picture. So the loans from that company would not be subject to FinCap. And under the new rules,
it is not so easy
we
to
go all red.
yeah, it is not so easy to structure the financing to avoid thin capitalization restrictions. As comparing to the previous slides, you will see that the entities which used to be not qualified lenders, which is grandparent or companies or subsidiaries, are now excluded from the good lenders and fall under the thin cap restrictions. And this will also be the case of the, let's say, sister example, with one exception. Again, this is not changed. If we look at the structures where the participation in a company or voting rights in the company, in fact, are below the 25%, then we can keep the disqualification of the lenders for the purposes of thin capitalization.
And again, if we were to add other companies from the group structure, anytime we would have over 25%, we would be red. So the picture would be really a red one. So that's the reality. And maybe summarizing the rules, the new rules from the other perspective, we said that it applies to almost all companies from the group. Maybe it's worth mentioning what it is a loan. So the loan is defined broadly. In fact, it is all kinds of, let's say, debt instrument on which we pay certain interest. The only exclusion are the derivatives. We were thinking whether it's possible to structure, let's say, something which economically is to be a financing in a way which is a derivative. It seems not so easy, but probably over the time some ideas will be developed. Again, the debt is calculated at the last day of the month preceding the month of the payment of the interest. What is a novelty is that we exclude from the debt of a given company all loans which were granted to, let's say, related parties. I mean, it's not clearly written whether those are related parties in terms of transfer pricing regulations or related parties in terms of FinCap. It's rather the second version, but still such loans are not calculated within a debt which is taken into account when analyzing the FinCap position. And then what's own equity? Again, we calculate it at the end of the month preceding the payment of interest. What is not included there, it's the capital, the part of the equity which results from the revaluation. It's equity stemming from subordinated loans, which is in fact interesting because the law directly indicates that only subordinated loans are, let's say, tainted, whereas I can imagine a group loan which is then converted into equity, which was not subordinated, and then probably it should not be excluded. And then again, what was in fact also in the current rules, part of the share capital which is not covered, which is covered by loans or interest, but please note that this refers only to share capital. So let's say share premium or reserve capital which comes from loans should be okay. And then covered with intangible assets which are not subject to depreciation under Polish FinCap. So those are examples of, let's say, bad equity, which is not included into the calculation of the equity. Last thing, which is again a novelty, and we would like to stress it because it's very well hidden, in fact, in the law, because you will not find it in the existing rules which were just changed. You will find it in the article which refers to the alternative method, but the definition of the interest presented in the article about the alternative method also refers to the, let's say, regular or standard method. So what's important, commissions and kinds of bonuses related to the debt instrument are also included and treated as an interest. So we should check the FinCap position when thinking about whether they are deductible or not. Okay, so
another revolution, which is the alternative method for exclusion of interest cost from the tax settlements of the taxpayer. New regulations assume that the taxpayer has a kind of an option whether they want to follow the thin capitalization restrictions, which are provided only for related but also indirectly related partners, or they should maybe think about the alternative methodology for the approach of exclusion of interest cost from the tax result by which covers not only the related party financing but also external financing, meaning, let's say, bank financing or any third party financing. This methodology assumes that we exclude particular or given amount of an interest which is dependent on the rate announced by the National Bank of Poland, and it is multiplied by the net value of the tax value of the assets of the company. However, in any way, it cannot exclude more than 50% of the operating profit of the taxpayer.
Yeah. So what we do, we take the interest rates, the hypothetical interest rate, which is fixed. I mean, we don't control it. It depends on the rate published by the bank. It's just increased slightly. Then we take the net value of assets. We calculate, let's say, the hypothetical deduction, and then we check whether this is it does not exceed 50% of the existing profit. So, I mean, not really controllable methods, right?
This option needs to be notified to the tax office if we want to follow it. So by definition, in fact, we follow by the standard thin capitalization restrictions. And what is more, it gives an option for the carrying forward the interest which were not subject to deduction for the next 5 years, which in some cases might be useful or attractive.
Okay. In fact, we have doubts whether this method works, but let's go example by example to discuss it. We start with the old rules. The assumptions of the example are the following. We have the asset which we want to finance at the value of 100 million euros. Then we have the bank which finances the acquisition at 60%. I mean, the acquisition or construction or any other way. So what we need is 40% of our own funds. The interest on a bank loan is also important for the alternative method, but this will be later. And then, for purposes of comparing the overall financing efficiency, we also assume that the interest on the intra-group loan are paid to the country with which Poland has a 5% withholding tax rate on the interest. And then let us see what results under the current rules, so let's say until the end of December in most cases, assuming that we do not provide the loan from a FinCap qualifying lender, but from the, let's say, non-qualifying lender. In this case, we just took grandparents. It could be any other financing company from the group. So, as you can see, on 30% of 100 million euros, we have a grandparent loan. So, we assumed interest 6% just for sake of an example, which means that we have 2.4 million of the interest annually, which gives us the tax shield of, let's say, around 500,000 euros. And then what's also added or should be taken into account is the withholding, which we would pay on those interests, which is 5%, which is 0.12 million, and Polish famous PCC or tax on civil law transactions, which generally is applicable to the loans, but in fact this could be eliminated by proper structuring. So that's why we indicated that it's manageable. Let's see what if we were under the FinCap, but current FinCap. Then to have a full deduction of the interest, we could only provide 75% of our equity, which means 30 million, because our equity is 40, and 10 million as an share capital. Then we would have all all interest deducted, but since this is only on 30 million, then the interest would be 1.8 million. So clearly, keeping the same interest level, we have a lower tax shield, which is 0.34. But we would have no withholding because we would be protected under interest royalty directive. So that's why there is no withholding. And we would have no PCC because the loans from direct shareholders are also excluded from PCC. So if you compare this example, one could say that taking withholding into account, we have, let's say, relatively comparable overall results within the group. Of course, taking withholding out, the first option is slightly better. Increasing the interest rates gives us even broader difference, but it's just an example.
We exclude also the cost of PCC on the increase of share capital, which to some extent may impact on the final result of the example, but anyway, it is not so material because it is only 0.5%, so it should not impact materially the example.
Okay, and now new rules. We assumed parent loan. We assumed parent loan because it's much easier for the withholding perspective, since anyway the group financing is under the FinCap, so let's have a loan from a parent. And then that's a big assumption that we have the 50% of equity, which means 20 million, but as we said, the equity will be changing over the lifetime of the project, right? Because any net loss, net profit of a given year will impact the equity. Also, there are other issues impacting the equity. But assuming this is fixed, we can go with 20 million of intra-group loan, with 50% of our equity, which gives us at 6% the interest of 1.2, which gives us tax shield of 0.23. Of course, half of the tax shield in the first case. We have no withholding and no PCC. We don't have to increase share capital, so in fact we may achieve effectively almost no Polish transfer tax. So as we can see, not doing anything, we are significantly limited, right? But one can say that on any 100 million of financing, assuming bank financing, we lose between half of or 1/4 of the benefit. And alternative method, for this, we needed to take into account the bank interest as well. Of course, we took the entire equity as a loan, so we have interest of 2.4, but we must add the interest of the bank to the entire picture, which is 1.8, because we assume the bank at 3% on 60 million. So we generally have we generally have the interest at the level of 2.4 plus 1.8, right? But assuming following this method, we can only deduct 2.25 because this results from the national bank rate, and we can only deduct 3.25 if our operational profit of the given year is 6.5 million. So while this may sound interesting, it only works better than the standard option if we have the operational profit. So let's say this is for a business plan which shows profit, and let's say it's relatively stable, we can consider this, but not necessarily for all the projects.
And what is more, also the rate given by the National Bank of Poland is subject to changes year by year. So this is not exactly something we have under full control, and it is quite difficult for purposes of planning of the tax result at the year end, because it will be to some extent below our control.
Yes, and in fact, what I consider the change adversing mostly the situation of the taxpayers is that you actually cannot control, because in the existing rules, as you can see in the first two columns of the example, we can actually control the situation. I mean, you can even follow the we can go with the loan from the direct parent, be under FinCap, but since you control the share capital, you just know that over the lifetime of the project, you will be able to deduct the interest on a regular basis.
Apart from the financing in foreign currency, when foreign currency exchange rates will determine our impact, our final result.
Our value of debt. But the impact would be then rather limited, comparing to the impact of the changes which may happen under the new rules. Okay, we even assume that at the start of the project we go 50-50 with the loan and overall equity, whatever the form of the equity. But then after 1 year, if we have significant loss, then our equity goes down, and then immediately our capacity of deduction of the interest is reduced. So this is it may highly fluctuate, which means that we don't control from the very beginning, and this is something I would say quite troublesome.
And to some extent also the taxpayer would need to have a kind of trade-off whether they want to distribute the profits retained in the company, or allow it to be kept for the purposes of, let's say, calculation of the FinCap restrictions.
That's true, because if we have positive results, then we increase our, let's say, capacity of deduction of the interest. But if we distribute the profit, then again we reduce it. Okay, so this is, I hope, useful example. Some good news.
The grandfather rules,
which also refers to one of the questions asked. Okay, so we have good news as well.
The new regulations assume that they don't want to create a big revolution or a kind of a surprise for all the taxpayers, but it is also assumed that the loans which are actually given, or even they are transferred until the current year, so before the new regulations come into force, should not be subject to new regulations, but should be covered by the currently existing rules. So this in fact means that if we have a loan agreement signed this year, we need to also transfer the cash under the agreement this year as well. If we prepare a loan agreement, let's say with the options that we transfer part of the cash this year and part of the cash, a tranche of cash next year, the tranche which is subject to the transfer in 2015 should not be covered by the currently existing FinCap regulations, although it is formally given on the paper still in 2014.
What can be added here is also that, I was looking at the question at the same time. So what can be added is that for the companies which has a non-calendar tax year, the old rules are applied until the end of their tax year, which should include as well, answering directly to the question, which should include as well the companies which tax year started in 2014 but ends at the, which just includes, sorry, I just wrongly read the date. So for the company which tax year ends at 21st January 2015, they should follow the old rules until the end of January, so end of the tax year. We have certain doubt whether the loans granted already in 2015 but within the tax year which started in 2014. So using the example, we have a tax year which started 1st February 2014 and ends end of January 2015. The question is whether a loan granted in January 2015 can benefit from the old FinCap rules. We believe so, but this is not clearly written in the law, and there might be other interpretation which says that this loan is already under the new FinCap. So this is not I would say 100%. There is no 100% clarity in the law on that.
But still, it follows the logic that the taxpayers whose tax years were not begun before the new regulations come into force should follow the already existing rules. So in fact, there are arguments, and quite good arguments, to claim that this example should not fall under the new ThinkUp regulations, but as Paweł said, this is not directly written in the
We would prefer to
law.
have it written with more clarity, if that was the intention of the legislator, which we hope it was, by the way. Okay, so grandfather, maybe summarizing in one sentence, the loans which are already in place should be under the old ThinkUp until the end of, until the maturity. So one of the relatively simple option is to also extend maturity of those loans to benefit from the preferential, I would say, definitely more preferential rules for ThinkUp. But looking at the slightly more, let's say, sophisticated situations when we can have still certain, I mean, more benefits than those resulting from the new ThinkUp rules. New financing structures.
We can either follow the grandfather rules, as we already said. Loans given until the end of this year should follow the old regulations. Maybe the companies with the extended tax year should also be covered by the old regulations. This is not clear. Maybe should be subject to individual tax ruling. We will see what is the practice, in fact, at the beginning of the next year.
Maybe one thing also to one idea to show. I mean, definitely we have to use the loan. I mean, we have to receive the loan amount this year to benefit from the old ThinkUp. As Magda said, not only signing of the loan agreement is required, but we also need to receive the loan amount. But not necessarily we have to keep that loan amount for our own use. We can own lend it, for example, and then have it back once we really need it. So there are some ideas how to, let's say, use this grandfathering rule in an efficient way, but they of course should be matched, should be applied only if really within a group it really makes sense. But it's not so, I mean, there are some options, right?
We can also think about the already checked and used methods in the past for avoidance of capitalization restrictions. One of them is quite, let's say, controversial, but still it is used in practice and also approved in practice by the tax administration.
Sounds unreal, yes.
This is because we, let's say, artificially, or to some extent at the very first glance, artificially divide repayments by repaying first the loan principal and at the next day, let's say, interest on the loan. As we said at the beginning, because we take a look on the now we take a look, we check the indebtedness of the company at the day in which the repayment of interest takes place. It allows us to say that if the loan principal was already paid, in our example, the day before, upon the payment of interest, the indebtedness is so low that it is not covered by the ThinkUp regulations. We can follow this methodology also under the new ThinkUp regulations, with one exception. We need to look at the end of the month for checking the day of indebtedness. So we should, in fact, make a repayment of the loan principal at the end of the month, and at the beginning of the month, let's say, interest on this financing.
And this, at first glance, may sound strange, but in fact, under Polish law, it is perfectly possible to repay the principal first, if the parties agree so. So, I mean, really, this option may work. I can imagine that it may sound a bit strange, but it's just also regularly confirmed by authorities. So yeah, this is probably the simplest method, maybe not the one which we could call a structural one, but still
it should work.
Working.
It should work. For those of the taxpayers who are not interested in the alternative methodology of the exclusion of interest from the tax settlements, we can also think about bank financing for instead of intragroup financing for avoidance of the thin capitalization restrictions, based on the assumption that the taxpayer is cooperating with the bank for giving the financing for a particular project within the group and with the kind of a collateral given by the group.
Yeah, it's maybe group deposit at the bank. It was used, it's been used so far. It's not very, I mean, it costs something because the banks prefer to earn something. So it's not very popular methodology, but it is possible. Slightly more, let's say, sophisticated or slightly more options which are slightly more backed on already existing rules. What we believe may work is focusing on some specific wording of the regulations, which refer to the entity which grants the loan. And if this is a sister company, and it has to be a company under the corporate income tax law, whereas a company under a corporate income tax law is only an income tax payer, which mean or may mean that loans from partners, I mean loans granted by partnership, of course they can still be fully controlled, but loans granted by partnership could be outside the scope of the regulations because they are not the loans granted by the company or by a company, within the meaning, of course, of these rules.
Paweł is now saying about the Polish partnerships, which are by definition, apart from joint stock partnership, CIT transparent entities. We can also extend this rule with respect to some foreign partnerships, but with this one condition that they should also be CIT transparent entities, not to be treated as a taxpayer for the local regulations, because then they would also fall under the definition of the company, which disqualifies the lender from exclusion of the FinCap regulations.
Yeah, and there is also one trick which always remains. This is the withholding. Then, of course, it really depends on how we structure the financing, but the withholding may be an issue here, even if we could be outside the FinCap. Second idea is the use of the Polish fund. We believe that, again, based on the wording of the regulations, loans involving fees or Polish fund in the structure could benefit from more preferential treatment. I mean, could be outside the FinCap. That's again because the fund does not issue shares and is not a company under the under the Polish corporate income tax law, which again, if we look at the wording of the regulations, should mean that in certain situations the loans from fees or having fees within the structure could allow us to avoid or eliminate the FinCap restrictions. That's, of course, using fees is a standalone issue because it's a different form of entity. It has certain limits. It offers also some benefits. But having this or considering this, we can add, let's say, to the benefits that this can also be used as a financing company or as an intermediary entity within the financing structure. And the last one, which we wanted to indicate directly, is is the option referring to different division of voting rights versus profits. I mean, you may remember that the Polish FinCap follows the voting rights. So if a given company has over 25% of voting rights within the financing company, generally the loans from such financing company may be subject to FinCap. However, it is possible to structure, even for a corporate purposes, to structure financing structure in such a way that voting rights in a majority, I mean over 75%, are allocated to a non-controlled entity. In fact, it should be rather private individual. But at the same time, the corporation or the group giving the financing has full control over the entire the project, the financing, the equity invested. It requires careful approach from the legal perspective, of course from the corporate governance perspective, but it is we believe it is possible, and let's say this is also our belief is also supported by the practice in this case. But again, probably it's not for all groups, but in certain cases it can work very well, because this structure also allows us to eliminate the withholding. So we can have a financing which is with no thin cap restrictions and with no withholding, which is not that bad. And well, as regards the ideas which may give some extra benefits in the context of the new thin cap, I think this is all we have. And in fact, this is the end of our webinar, unless there are some questions which are not answered. But I think we answered all the questions about the, let's say, all grandfathering rules.
But still, if you had any other questions apart from those which were already asked, you can find our contact details, I believe, on the next slide. So let us know, and we will contact you directly, and we can also discuss your questions or your structures on the new ideas on the ThinkUp revolution. Exactly, and so this is the end. And thank you very much for participation, for listening, and yeah. Thank you. Thank you. Goodbye.